In a significant shift in global economic dynamics, Canada appears to have found an unexpected lifeline amid U.S. trade pressures, as China positions itself as an alternative market partner. This development comes as America's trade wars extend beyond China to traditional allies. Our senior economic analyst reports that the Trump administration's 20% tariffs on Chinese goods have triggered an unexpected chain reaction. Rather than yielding to pressure, China has pivoted, reducing American imports while strengthening trade with Canada and the EU. The implications for American businesses are severe. Major U.S. corporations face unprecedented challenges. Apple, manufacturing most iPhones in China and deriving 16% of revenue from Chinese consumers, is experiencing market share decline. Qualcomm depends on China for nearly half its revenue. The automotive sector is equally concerning. General Motors sells more vehicles in China than in the U.S. 3.8 million annually. These sales are now at risk. Similarly, Nike, which generated $7 billion from Chinese markets last year, and Starbucks find themselves in precarious positions. The ripple effect spans multiple sectors. American farmers, energy suppliers, and manufacturers face impacts as they lose access to China's market. As prices fall, competitors from other nations fill the void left by U.S. businesses. The situation represents a miscalculation in trade strategy. Instead of weakening China's position, the tariffs are accelerating global economic realignment. Canada and the EU's pivot toward China raises questions about America's future economic influence. Industry experts suggest this could mark the emergence of a new global economic superpower structure, with China at its center. The question isn't whether this shift will impact American economic dominance, but how severe these changes will be. Good evening, I'm John Mitchell with breaking news on America's economic challenges. Our top story tonight focuses on how U.S. tariffs on Chinese goods are creating a devastating ripple effect across the economy. When the U.S. imposes tariffs on Chinese products, American companies must either absorb the costs or pass them to consumers through higher prices. The impact is visible in everyday items. From coffee makers to garbage bins, and beverages in aluminum cans are becoming more expensive. Some politicians hope these tariffs would bring manufacturing back to American soil, but reality proves otherwise. Labor costs in the U.S. are significantly higher than in China, making domestic production more expensive. When American toy manufacturers saw increased orders due to tariffs, they had to raise prices to cover production costs. The U.S. lacks infrastructure for large-scale manufacturing. Many industries moved overseas decades ago, and rebuilding supply chains would take years and billions in investments. Even with tariffs, production in China remains cheaper than in the United States. The aerospace sector relies on specialized parts manufactured overseas, and relocating production is both complex and costly. Companies have spent years building their businesses in China, and leaving isn't simple. Beijing's response has been swift. Instead of yielding to pressure, China has reduced imports of American goods while strengthening trade ties with Canada and the EU. This diplomatic move is reshaping international trade alliances, potentially leaving the U.S. vulnerable. The agricultural sector is particularly affected. American farmers, once dependent on the Chinese market, now face plummeting demand, surplus products, and falling prices. Energy suppliers haven't escaped unscathed as China reduces imports of American oil and gas, triggering market uncertainty. This is John Mitchell, reporting on the economic front lines. Back to you in the studio. In a dramatic shift of global trade dynamics, the United States finds itself increasingly isolated as competitors rush to fill the vacuum in Chinese markets. Our analysis reveals a concerning trend where America's strategy to maintain dominance is backfiring, pushing itself out of key international markets. Major U.S. retailers, particularly Walmart, struggle to balance rising tariff costs without alienating price-sensitive consumers. Walmart has been pressuring Chinese suppliers to lower prices to offset tariffs, a move that caught Beijing's attention, leading to tense negotiations. China is capitalizing on the growing rift between the U.S. and its traditional allies. Chinese diplomats are making significant inroads across Europe, presenting themselves as stable partners to EU leaders who have grown weary of aggressive American trade policies. This diplomatic offensive appears to be yielding results, undermining U.S. interests in European markets. The situation becomes more complex as Canada pivots towards China, particularly in the energy sector. Following Washington's decision to impose 10% tariffs on Canadian oil imports, Ottawa has made a strategic shift toward Beijing, altering the global energy landscape. The Trans Mountain Pipeline project enables Canada to bypass U.S. markets and ship oil directly to Chinese ports. Economic warning signs are flashing in the American economy. While inflation remains contained for now, new tariffs threaten to push prices higher, leaving the Federal Reserve in a difficult position. Either combat inflation or rescue an economy struggling under trade war pressures. The irony hasn't been lost on observers. What was intended as a strategy to weaken China has instead helped Beijing expand its allies. As traditional U.S. partners seek alternatives, America's global trade influence continues to erode, raising questions about current trade policies. Breaking news from North America's shifting energy landscape. Canada's bold move to reduce dependence on U.S. refineries marks a significant turning point in continental energy dynamics. A major LNG terminal project in British Columbia, launching in 2025, symbolizes Canada's emergence as a global energy player, with a 14 million ton annual capacity. China's growing interest in Canadian LNG supplies highlights Beijing's strategy to diversify energy sources and decrease U.S. imports. Canadian energy companies are strengthening Asian market ties, shown by ARC Resources' deal to supply 1.5 million tons of LNG yearly to ExxonMobil's Asia-Pacific division. In response to U.S. tariffs, Canada considers countermeasures including restricting oil exports or implementing export duties, potentially impacting American refineries dependent on Canadian oil. These developments reflect China's strategy to enhance energy security amid geopolitical instability. By diversifying resources and increasing cooperation with Canada, Beijing is reducing U.S. influence in global energy markets. American farmers face a historic crisis. The agricultural sector nears collapse due to China's shift in trade partnerships. Soybean, wheat, corn, and pig farmers have been hit hardest. U.S. soybean exports to China dropped from 40% of Chinese imports in 2016 to 18% recently, while Brazil and Argentina now supply 74% of China's needs. This has led to overproduction and price crashes in U.S. agriculture. Many farmers face bankruptcy. The crisis affects the entire agro-industrial complex, including processing facilities and rural communities dependent on agricultural income. The situation represents a reshaping of global trade alliances and energy partnerships, questioning the future of international economic relationships. Here's your 1,800-character news report. In a dramatic turn of events that's shaking the foundations of American agriculture, the U.S. Department of Agriculture has been forced to implement an unprecedented $12 billion aid package for struggling farmers. I'm John Anderson, and this is today's Economic Breakdown. Let me paint you a clear picture of what's happening in America's heartland. Soybean farmers, who've taken the hardest hit in this economic battle, received $8 billion in compensation. But folks, this is just a Band-Aid on a much larger wound. Our sources indicate that transportation companies and agricultural equipment manufacturers are bleeding money at an alarming rate. But here's where it gets really interesting. China, in a calculated move, has dramatically increased its pork imports from the European Union by 35%. This strategic shift is effectively pushing American exporters out of one of the world's most lucrative markets. The Chinese retaliatory tariffs, which cover practically every agricultural product from American soil, have rendered U.S. goods virtually non-competitive in the global marketplace. Now let's connect the dots here. China isn't just throwing punches. They're playing a long game. They're systematically reducing their dependence on American imports while diversifying their supply chains. This isn't just about soybeans and pork anymore. It's about global economic dominance. Here's what should keep you up at night. If Washington doesn't revise its trade strategy soon, America risks being sidelined in global supply chains. The stakes have never been higher, and we might be witnessing the twilight of U.S. dominance in world trade. But don't touch that dial. This story is far from over. The global economic chessboard is still in play, and we'll be here to break down every move. Remember, these aren't just numbers on a screen. These are real American jobs and livelihoods at stake. Stay tuned to our channel for continuous updates on this economic showdown that's reshaping our world. This is John Anderson, signing off until next time.